So think when you said like, generally speaking, why would you say planning, just beyond the portfolio? We talk about it all the time. Do you have a portfolio or a plan? But why is that, like, as you approach retirement, what is the thing that you see as a result of good planning?
Yeah, so as a result of good planning, first and foremost is confidence, like I was saying before, but you can also relate that to the various aspects that we cover here at SHP as well. So I think everybody knows at this point, we focus on income, investment, tax, healthcare, and legacy. And it's a common topic of conversation right now is investments and market volatility, which also ties into income planning. And that's very important because I think a lot of people, when we first sit down with them and they've been on the ride through the accumulation phase basically their whole life, and because we've been on a bull market for about the last 12 years or so, people have gotten very comfortable with making money and just kind of let it ride. And so I think a lot of people kind of got away with not having a plan. And I'd also argue that having a plan during the accumulation phase isn't as critical as the distribution phase. So I think that's very important as you approach that distribution phase, is to start to think about, what are my goals? How am I going to address them? What things do I have to be careful of? And that's really what we try to do for all our clients at SHP.
Well, I would say, and I think one good example of that, excuse me, one good example of that is just recently, at least with the recent market volatility, is that, sort of firm-wide, we have been slowly but surely going through each individual case and then applying a bear market. So let's just, but it's also an individualized bear market, Like in Derek, in some of our past podcasts, we've talked about, the importance of technology and risk analysis and whatnot. So we do this, very handy risk report that we're able to kind of put clients, all their portfolios, stocks, bonds, annuities, whatever it might be, into a holding. And then we stress test it based on, or back to 2008 and what happened in their bear market. So each individual, so Derek Gregoire, the Gregoire household has a
my risk score might be 42.
Right, exactly. Right. And the Nelson household will have their bear market scenario, and then the Peck household will have theirs. But it's an idea of, what's the current market volatility now? And let's add on an additional anywhere from 15 to 20 to more loss. Yeah. Okay, what does that mean for you long term? And then helping to explain to somebody, say, okay, all right, that's a big deal if it happens now. It's oddly enough, it's less of a big deal if it happens in the future. Yeah, because the sooner it happens, the worse it is. But I think it's a good example of just taking sort of something that's obviously topical, to say the least, in the current correction bear market we're in right now, and then seeing, okay, what if it gets worse, and what does that mean to you long term?